Hey guys, Brian Stevens here with NREP and Mortgage Shots. I have Eric Bowlby with American Pacific Mortgage. How are we doing today, Eric?
Doing fantastic. How are you doing?
Doing really good. So I want to talk to you about something very specific that we've had conversations on in the past. And it's really about this whole notion of bank failures. We saw Silicon Valley Bank and a couple others failed a few months ago, and that seemed to kind of stem the tide of all of that stuff. But we just saw the First Republic Bank failed, and their smoldering remnants were purchased by JP Morgan Chase.
Yeah, look, my opinion, we're at the tip of the iceberg.
Okay.
We got a lot more coming our way. And we're only hearing the headliners. I guarantee you there's smaller community banks that are failing all over the nation. Whenever the market turns the way it did, it's a huge problem for an FDIC bank. And then you take in with the run on the banks that people are having, it's very difficult for a small community bank to survive an environment like this. You go back to movies like It's Too Big to Fail. That's really where the government prefers. They'd rather think of it as from a regulator standpoint of view. Would you like to regulate 10,000 FDIC banks across the nation or 5?
So are you suggesting that the whole too big to fail was a fallacy from the get-go?
What I'm saying is that's why the government wants them. They want banks that are too big to fail.
Right.
It's easier to keep a smaller group of banks in line than it is to keep 10,000 banks in line.
Okay, then why did we, from the Dodd-Frank Act back in 2009, why did we pass too big to fail? Saying we don't want too big to fail anymore. Why that then, and why the change of heart now?
I don't think it was ever a change of heart, right? You got to think of regulation the same as you go to a magician's show. When you go to a magician's show and he tells you to look to the left, where should you really be looking?
To the right.
To the right. That's regulation. If you don't think that they don't prefer working with Wells Fargo, Bank of America, Chase, Citi, and US Bank, you're wrong. They like it that way.
Right, because they can control them and they can sue them and they can create headlines for them. This a little bit of a setup on my part here, Eric, because I found some stuff that I was like, this can't be true, and I want to share this with you, and I want to get your thoughts on it. Basically, It's exactly what you're saying. So, did you know on one date, and it was on the 28th of August in 2008, Wells Fargo, State Street Corp, Bank of America, Citigroup, JP Morgan Chase, Morgan Stanley, Goldman Sachs, and Bank of New York Mellon, they all took bailouts on that date. Over $1 trillion in loans and hundreds of billions of dollars in capitals and guarantees. They flowed into financial institutions on that very day. And if you remember, shortly thereafter, we said we can no longer have banks that are too big to fail. We got to get rid of these big banks. They're killing us on a day that we handed out $1 trillion.
By the way, not all of them wanted that money. It was forced. It was forced on them.
It absolutely was. The acquisition of Morgan Stanley by Bank of America was forced on him by Hank Paulson and Ben Bernanke. They told what was his name? Ken Lewis, the head of Bank of America at the time. They said, if you pull out of this deal where you're purchasing them, you're not going to have a job tomorrow. He says, but it's bad for us. They said, we don't care. So they ended up acquiring Morgan Stanley, and the shareholders got rid of them anyways. But here's the thing that really tripped me out, and I didn't know this until just today as I started looking this up. Did you know that too big to fail as a policy from the Dodd-Frank Act, from the last meltdown? Did you know it was repealed in 2016?
I did not know that.
I did not know that either. Well, and because I'm like, whatever happened to too big to fail? Because JP Morgan Chase just got a hell of a lot bigger. Let's see. Let me go down here. Okay. This is from March 29th, 2016, from the Government of Accountability's office, titled Ending Too Big to Fail. So this is from the Government Accountability's office. It's the GAO.gov. And it says the title of the article, or the title of the piece that they put out, is Ending Too Big to Fail. There's a quote: large banks are now considered safer because the expectation about government bailouts has shifted. Now they're saying, okay, if we're going to bail out, let's just bail out a couple of the big guys, the systemically too important to fail companies, banks, than anybody else. Big banks are now back in favor. In fact, one analyst raised the possibility that if the nation were back where it was 8 years ago, now this is when they repealed it in 2016. So if we were to go back to 2008, in the throes of the financial crisis, big banks would again see lower borrower rates relative to smaller banks. So bigger banks would benefit over the smaller banks. That is, it is possible that they would reap the benefit of being too big to fail when it matters the most. When does it matter the most? During times of crisis. When are we having a time of crisis? How about right now? So this is what they were talking about in 2016. They said, well, hold on a second. Bigger banks are going to reap the benefit of smaller rates. And in times of crisis, having these larger institutions is going to be better. That's exactly what's taking place right now. And that's exactly what we saw with the acquisition that Chase just went through with yesterday. This was from 2016. And now ask yourselves, did this whole thing come true? We don't need to look any further than the First Republic, their failure, and the fact that JP Morgan Chase just got even bigger. Pretty crazy, isn't it?
What's even crazier is the government is lending them the money to do the acquisition.
Yeah.
Right?
But now why, okay, we've gone over this before, but for those of you who didn't see it, why are these banks failing right now? What is particularly different today than it was a year ago, or maybe a year from now?
Yeah, so you got a few factors that come into it, and then you have to keep kind of reading further and further along. So some is fact, some is speculation. So let's just talk about what it takes to be a bank in general. Banks in general lend money. You have to lend money in order to make money. And how do you lend money? You start out with deposits. So people come in, they deposit money in your bank. Call it tier 1 capital. They have tier 1, they have tier 2 capital. So tier 1 capital, you get a 20-to-1 ratio. So let's say I go and I deposit $100,000 with Chase. Chase can now trade that 20-to-1, so $2 million at the Federal Reserve window. And they were borrowing that at, let's say, a cost of 0.5%. So when they were getting it at 0.5%, they were now lending it out at, say, 3.5%, 4%. And what is the number one thing that all banks, what type of paper is considered the safest type of paper to carry on a bank's balance sheet?
Bonds?
Commercial.
Okay.
We're going to come back to that in a minute. The reason I like commercial, most commercial has a balloon payment. So you're putting yourself out with little risk, because the worry you have as a bank is your cost of funds. So let's take that scenario. I did a loan, $1 million on a commercial building. I did it with a $50,000 deposit that I had from Brian Stevens. I got my $2 million. I got my $2 million at a cost of 1/4 or 0.5%. Plus, I'm paying Brian. What were they paying just a few years ago? 0.25% if you had your money in the bank.
Yeah.
Okay, so they paid you 0.25% on your $50,000. Then they paid the Federal Reserve to borrow money from them to be able to lend out 0.5% on theirs. And what's the cost of capital today?
You tell me.
7 3/4.
Okay.
So I lent my money out at 4%. I'm paying you, and I'm paying the Federal Reserve now, but my cost of funds from the Federal Reserve went from 0.5 to 7 3/4. But I lent the money out to the person on the commercial building at 4.
3 or 4. Okay.
I have a problem. Now, I'm going to recast it somewhere down the road, and that's going to be the next part of failures. We're going to come back to that. Remember when I mentioned recast, and if I forget, make sure you bring me back to it.
Okay.
So now my cost of funds, I'm upside down. And if you have a ton of that, you have a problem. And everyone has a ton of it, because we had low rates from 2019, got really low in 2020, and they didn't come back up again until 2022. And anybody who had an outstanding mortgage, whether it was a commercial mortgage or it was real estate mortgage, you got your rates down in the 3s and the 4s, right? That's what everybody did. Now you got to wait to the recast. Most commercial are 5, 7, or 10-year balloons. Well, the rates went up, and they went up very fast. So the banks don't have the ability to outrun their problem. They were also asked by the federal government to buy treasuries, buy bonds, and said, don't worry, it's cheap, you'll be fine. Again, same thing, your cost of capital is now more expensive than what your receivables are. Doesn't take any genius to know that's a problem, right? As much as it can be profit on one side, when it turns, it's a huge negative. It's actually why the FDIC does not like the mortgage space. They don't like the mortgage space because 30-year terms are dangerous. Unless you have sold them to Fannie, Freddie, or it's in a bond with a Jenny, or you did your own securitization pool, right? That's why jumbos are always the most volatile program on the market. If you go back to 2007 through, say, 2010, we went from financing 100% up to $2 million purchase price back in 2010. or 2007. In 2009, it was a minimum of 20% down on a jumbo, and you had to have 6 months reserves and 800 FICO scores, and your rates were way out of market compared to a Fannie, Freddie, or Ginnie. So, and the reason for that is it's a risky proposition. Unless you have your own shelf that allows you to do your own securitization, which is companies like Lehman Brothers, Goldman Sachs, companies like that, or you're a big bank that's going to go out and do it, because a portfolio product is nothing but dangerous when you're talking about a 30-year fixed. Banks in general like ARM products when they're in portfolios because it's going to rotate out. Now, the problem with the recast, and this is why I say we are at the tip of the iceberg. When these loans come into recast, when you're financing on a commercial loan, it's all about the cap rate. They got to see what is the debt service coverage ratio on your property. Well, your debt service coverage ratio is much different at 7% than it was at 4%. And now you're going to have to get that customer to come in and you say, well, you don't meet the underwriting guidelines anymore. What's your only option? You got to buy your loan amount down. You got to bring in enough money to bring it down to where it's within, get you your DSCR rating back up. Well, what if you don't have the money? What if you're $1 million loan that you need to buy down to 800,000, but you don't have $200,000 to bring in? What is your options? Foreclosure. Because no one's going to lend at you anymore. So as these loans continue to come to default, which is a massive problem, because thanks to COVID, all of these commercial buildings are starting to sit more and more vacant, right? Yeah. People are telecommuting. People who were in New York, they now live in Florida, and they get up in the morning and they make phone calls. They don't have to be in New York. In fact, New York is going to become I'm going to call it a ghost town in the commercial space. There's already a ton of investors flocking to New York, and they're going to try and take retail commercial and turn them back into condominiums.
Yeah,
right. That's where they're going. Now, the problem that they're going to find is nobody wants to live where these retail spaces are at, right? But they're just trying to figure out a way to not lose everything.
Right.
Because New York real estate is crazy expensive. They probably bought it high, and they're just trying to find a way to not lose money. And so this recast is going to become very problematic, because the next thing they do, you got to worry about the FDIC is going to come in. And this is what every bank's got to worry about today. They're going to come in and they're going to write down your assets. They're going to say, yes, you lent on this property for $1 million. And that $1 million note, now to get it in what we consider would be a viable loan to value position, you need to refinance it to $800,000. So they're going to take $200,000 out of your tier 1 deposits, and you got to move it over into loan loss reserves. That $200,000 is $4 million of money you used to lend out. So if you did and you maximized everything you could in lending, you now have to come up with money and to buy that down until the recast comes, and hoping that the recast comes in time that you don't have to have that money sitting on the sidelines anymore. And as soon as you start doing that, then you start selling assets. What are the best assets to sell right now? And if you don't know the answer, all you have to do is look to see what Wells Fargo's announcement. What is Wells Fargo selling right now?
What is it?
All their mortgage-backed security servicing portfolios.
They're selling off their servicing right now?
They're selling off their servicing, because that's the one thing that today, if you did a bunch of loans in 2021, very low interest rates, they're going to probably be around for 7, 8, 9 years. So you're going to get a higher yield on those. Now, you're giving up a great asset, right? Anybody could hold on. In fact, and not to toot their horn, because they are the largest lender in America, but the only large company that's not FDIC that survived the last 3 or 4 downturns is Quicken Loans. And I hate to give them any press, but the reason they survived is they were able to hold on to all their mortgage servicing rights. And that mortgage servicing rights pays their monthly bill. And I'm sure Wells Fargo is making a ton of money off it. Like they own, I think it's a little over $1 trillion in servicing rights. But instead of doing what Republic did, or Signature did, or Silicon Valley did, they were just trying to liquidate assets. Well, when you go to liquidate, say, a treasury, and it's got a yield on of 2.5% or 3% because the government told you to come in and buy them. And in today's market, if you went and bought a treasury at, say, a 6.5% to 7%, are you going to get 100% value?
Not even close.
No, you're going to get 60, 70 cents on the dollar. And as soon as that happens, and you have to post, and your depositees, if that's the right word, your people who are on deposit with you, see that you're selling off assets at a discount, they automatically have to assume something's going wrong. And if I've got more than $250,000 in your bank, what am I going to come do? Taking it out. Taking it out. And who am I going to go to? This is why I agree with them, why they said the too big to fail rule, let's get rid of it, which I didn't know until just now. if I'm because payroll is just as on the hook as anything else. So I think we were talking earlier today. Roku TV had hundreds of millions of dollars that was deposited with Silicon
500
Valley
million.
Bank.
Yeah.
How much was it?
500 million.
500 million, and they've got to make payroll, but that 500 million can disappear overnight.
Yep.
That is a problem. If you're them, where are you taking your 500 million to?
Well, I think their 500 million got stuck there. I don't think they got it out. I'm not sure.
If you can pull it out, where are you going to go to?
Where would
Wells
you?
Fargo, Chase, Bank of America, Citi, US Bank. You're going to one of the top 5, because if anyone's going to get bailed out, who's it going to be?
It's going to be them, because it's also been codified. It's a law of the land right now. And we know this to be the case, that certain institutions have been deemed systemically too big to fail. So now not only is too big to fail a fallacy, which we've known that for a long time, banks have just gotten bigger. Chase just again proved it. But they've actually made this a law of the land. So we know for a fact that Chase won't fail. And we know the bigger they get, the more systemically important they are. One thing I wanted to point out to you, Erica, is I just read this today and I thought it was like, wow, that's crazy. You're speaking about New York real estate and the vacancy ratio over there and how it's going to be a ghost town and how they're repurposing all this commercial space into residential space. San Francisco, for the longest time, would be vying with Manhattan for the most expensive real estate in the country, if not the world. Did you know that the vacancy rate in San Francisco's commercial space right now is 35%?
Wow, I did not.
30, it's short of 35, it's over 30, but it's pushing closer to 35%. That's a big problem. That's a big problem. There's a lot of zeros that are at stake there. How much money is going to be lost and how many financial institutions are going to suffer a consequence as a result of this? And if it's happening in San Francisco, you can bet your ass it's happening in Manhattan. It's happening in Chicago. It's happening in Dallas. It's not happening down there in Phoenix, is it? Phoenix is still in a growth pattern.
We're in a growth pattern, but I can tell you office space is not at a premium right now.
Yeah.
There's tons of subleases out there available. Even in Phoenix, people are choosing to commute.
So here's my question that I have for you. So if we have a lot of these larger financial institutions are going to get stronger at the cost of our smaller regional financial depositories, what does this mean for mortgage lending? Most of the big guys have already walked away from Fannie, Freddie, Ginnie products. They don't want a whole bunch to do with it. They don't have an appetite for anything outside of servicing. What effect does this have on rates, and what effect does this have on the mortgage market going forward in 2023 and beyond?
So there's a lot to consider in this. And I'm going to take you back in history. In 2007, what happened to most mortgage companies, especially the big ones?
In 2007, the wheels started coming off the wagons type of thing.
And what was the first thing that started making the wheels come off the wagons?
Property values dropping.
That led to it. That took a little bit of time. What was the first problem?
Payments adjusting. The 227s or the 327s and 228s.
Well, that's what the media told everybody, but those were all ARMs. And what did rates do from 2007 and on? They did nothing but go down.
Okay.
That whole fallacy, they told everybody these bad ARMs were adjusting and they couldn't afford the payments. That's simply not true. ARMs adjusted down. I know I had an ARM. And I remember just watching it drop.
But on the subprime loans where they had the margins in the 5s and the 6s, that they were adding to their indexes and they had the start rates of the 2s and 3s. Those were the ones, the subprime ones that went haywire, I think. But that probably didn't happen until a little bit later.
Yeah.
So rates went down.
No, the number one problem that happened is whenever the market crashes, everybody who has a loan going in default is looking to see if you didn't dot an I or cross a T. Because if you didn't dot an I or cross a T, you own the loan. You have to buy it back. You have reps and warrants that say you're on the hook. I can tell you right now, Fannie and Freddie are going door to door, knocking on houses that they believe were lied to about owner occupancy. They're looking to see that your second home, if you've ever posted it on VRBO. Because if you have, that's not a second home, that's an investment property, right? They are looking for this, and the amount of pushback is going to continue to get worse and worse. And then you go on to the next phase, which is what you mentioned. When property values start to drop, you eventually lead to the people who say, I'm out. I was fine when I had $100,000 in negative equity, but at $200,000 in negative equity, I'm washing my hands, I'm out of here. Then when that starts to happen, there's more pushback on buybacks because the more defaults, the more they look to see how can I push the loan back. Then you have all these little FDIC companies that start to go out of business. And they start to worry about, because everything on the news is going to revolve around mortgage. In fact, you're already hearing it. They actually state that one of the problems that in Republic Bank was they were in the mortgage space. Now, again, I always think if they're saying, look at my left hand, you got to look at the right hand. Mm-hmm. But if you go back to 2007, what eventually started happening was warehouse lines dried up. All of a sudden, the places that you used to do business with can't. I'll give you an example. This happened to me in 2009. So we already been a couple of years into it. In fact, AmeriFirst from 1989 to 2009, we only ever worked with one warehouse line company. I won't share their name just because they're still out there and it's embarrassing to them. But I finally got to the size where I needed a second warehouse line, and I had a company called Garrett & Associates. They're wonderful. They're one of the #1 auditors for warehouse lines in the nation. And they came out and they're interviewing us, and they couldn't believe that we'd gone this far with only one warehouse line. And as they kept stating it to me, you would have thought that like it would have opened up my eyes and I would have been thinking he was trying to drop hints to me. I didn't catch it. So he was out, let's just say it was on a Wednesday. The following Monday, I get a phone call from my warehouse line, who at the time I had a $60 million line of credit with them. And they say, hey, got some really bad news. We just finished our FDIC audit. Our new maximum lending loan amount limit is now $10 million. So you owe us $50 million. So we can't fund it. By the way, this happened the last week of the month. You can't fund going forward until you buy down below 10 million, which was the kiss of death. I was in trouble. Thankfully, the new warehouse line, because we'd already been through the audit, we went through credit committee. So only from Monday to Wednesday did I have a problem. Now, the sad part is Garrett & Associates knew there was an issue. They just didn't want to tell me because the other bank was also a customer there. So they have to protect their information. If I was smarter, I would have been managing it and watching myself. Well, then in 2009, thankfully we got that line, because then it became who can actually get a line. In 2009, all you had to do to be successful in the mortgage space was have a line of credit that allowed you to fund loans, because there were so many companies going out of business. By the way, very good companies. Think like in my backyard, we had one of the, if not the largest independent mortgage banker was out of Tucson, Arizona, a company called First Magnus. And they were ballers. And still to this day, if you talk to anybody who's from that era, they still talk unbelievably fondly about how great the company was, how their systems were spot. They were great. They were forced out of a business that shouldn't have been. In fact, if you go back and read it and you understand what happened, it was an absolute disaster that should not have. It took place by somebody forcing an issue that didn't need to be forced. Again, not my story, so I won't share all the details, but it didn't need to be. But that's what allowed everyone to grow. Well, at the same time, all these banks, when they start exiting, then you have to look and say, well, who's the buying of servicing rights and how competitive does it get? For the last, I'm going to say 11, 12 months now, the broker community has had this really good model because they weren't big prior to. So they didn't have all the negative things that some of us independent mortgage bankers had. They didn't have all these rents. They came in and said, we're going to go on the skinny. And at the same time, because there was so much demand for mortgage servicing rights and there wasn't enough volume, that third-party originators, companies like Quicken, companies like United Wholesale, Fairway, they jumped in and they made it to where an independent mortgage broker could compete with a banker, which hadn't been done. It was in 2018, that was the case. But from 10 on, that was certainly not the case, because nobody was paying huge premiums for MSRs, and nobody was operating on this. I'm going to call it the billionaires fighting over money, which is Dan Gilbert and Matt Ishbia. I don't even know how to pronounce it. Ishbia? Ishbia. There we go. You'd think I know, since he owns the Phoenix Suns. Anyway, if they weren't in this little pissing battle about who's got the biggest company, brokers, I don't think, would be getting nearly the rates they're getting today. However, this is where you got to be careful. What's the first thing government does when they see disaster coming? What's the first thing out of their mouth?
Regulate.
Regulate is bad for the little guy, especially if you had a thin model already built. So you come in, you say, I've built this model, it's going to be thin, it's going to get paid all this. And now all of a sudden, regulation steps in. In fact, I'll give you exact for my little company back in the day. Pre-Dodd-Frank to post-Dodd-Frank, my change in compliance, what it cost me to stay in compliance, was a $3 million a year change. 3 million. So now go, how does a little guy remain compliant? And that's where the problem will eventually rise is how can I afford to?
You can't.
And the regulators, again, if you're a regulator and you got to go through what's a disaster, how many companies do you want to regulate? The answer is the least amount possible.
You know, this is really a chicken and the egg conversation of sorts, in a sense that out of one side, they're saying we want the smaller regional institutions, that it makes banking better. It's better for consumers. Competition is wonderful. But out of, that's what we're saying. But then our actions would suggest otherwise, because they're passing regulations that are so cost prohibitive for the smaller guys to participate. And frankly, even the Fed's policies, based on the conversation that we've had, if the Fed is going to go from rates at or around zero, the Fed fund rate at or around zero, and then in a very, very short period of time, raise it up to 7 3/4, well, there is going to be a consequence of doing that. And the consequence is that smaller financial institutions who can't take the body blows are going to fail. This wasn't something that should have been unforeseen. It almost seems like this is deliberate. We want the little guys here, but we're going to pass policies and regulations that are going to guarantee their failure. Is that what we're seeing here?
Well, look, so I'm going to answer it two ways, and I'm going to go with a movie quote. In fact, I forget which movie this is from, but it's one of the best movie quotes of all time, and that is, if you want to see where the corruption is going to be had, follow the money trail.
Yeah.
Who has the biggest lobbyists? Is it the small banks or is it the big banks?
Yeah. So
big banks lobby. In fact, go back to LO comp rule. Who was the #1 bank lobbying for that?
Oh, let's see. It had to be either Wells Fargo or Chase would be my two guesses.
It was Bank of America.
Yeah.
Bank of America was the one behind it saying, hey, we don't like that we grow up and we teach all these people how to be originators. And then they realize they're worth more money if they go to the independent mortgage banker.
Right.
So let's make it to where it's more of an even playing field. And so that's, big banks have control of lobbyists. And let's be perfectly clear. Most politicians get put there by their constituents and people who are willing to make donations. When you make a donation, and I'm asking you specifically, if you make a donation, do you expect that they're just going to be idealistic and do everything that they want to do and it doesn't matter what you think? Or do you think, I paid you, you owe me, I want to see you do what I expect you to do?
Oh, if I'm making a donation?
Yeah.
A willful donation?
Mm-hmm.
Their only reason to do a willful donation is for ulterior reasons.
Okay,
Period.
so
Period.
anybody who's a politician, and politicians are who also put forth the bills, who then go and get someone to enforce them. So the people at the top are paying back the people who helped them get elected.
Yeah.
It's one of the most broke things that's in our system. By the way, I'm okay with it. I just want to be able to, have a step up to the plate and have a swing at the pitch.
Right.
I'm not one of these guys who goes, oh, it sucks, world's coming to an end. No, just know that that's what it is. So know first and foremost that that's the case. Now, secondly, and this is where I'm actually going to agree with the government on the too big portion. The little guys, unfortunately, just don't have the time that some of these big companies have had to diversify their portfolios. If I'm a small community lender, and I'm going to say Gilbert, Arizona, which is where I'm standing right now, and I'm going to go out and try to get deposits to compete with the big guys who have a ATM on every corner of the world. How do I compete? I have to pay more. So my cost of capital is higher. I know for a fact there was a time where Wells Fargo had so many deposits coming in, they were actually trying to deter people from bringing in money.
Yeah.
They were like, we got plenty. Everyone's rushing to us with this craze of back in 07. We don't need any more money. And so they
remember the first years when they started charging for checking accounts.
Right.
You want to put your money here. Well, you're going to have to pay us to deal with you as a hassle.
Yeah. It's because they didn't need any more capital. They had too much. And they went, we did, if we're going to take on, because by the way, it isn't free to have a checking account, right?
Right.
They give you a free checking account. Somebody still has to process your check. Someone has to monitor. Someone has to have compliant. It's not free to the bank. Now, your deposits, if you say, well, if they can trade them for, it's tier 1 capital and they get a 20-to-1 and they're getting a return, fantastic. But if they don't need any more capital and they have no ability to put it out to work, why take it? It's just a headache. It costs them money. I think I read somewhere, and I don't know if this is a fact, but I think I read somewhere that the average cost of the bank to maintain a checking account is like $27 a month. So they're giving it to you for free. That means they're losing $27 a month. So they better find a way to make $27 a month off you. Otherwise, they're going in the hole, right? So if you're the person who has that account that's always just barely breaking even, what value do you have to the bank? The answer is you're not worth anything. If you're the person
overdraft,
and that's why they charge crazy fees for it. They got to get their money back. So then you take these small, not only do they have to pay more for deposits, but I think you just said that they're actually, the bigger the bank, the better rates that they have access to, and right? And their economies of scale are also better because they, one general counsel at a bank that is a $20 million bank is a much different cost than if you have a general counsel who's at a $400 million bank or a $10 billion bank. So there's advantages to there, but also because they're so small, they don't have the ability to say, well, I'm going to lend commercial. I'm going to buy mortgage servicing rights. I'm going to buy, like, they don't have enough assets to go out and diversify themselves. So if this one's failing, this one's picking up the difference. Whereas the big banks do. They go, okay, well, if mortgages are down, how's our credit cards doing? How's our car loans doing? How's our business lines of credit doing? Right? They have all these different ways that they can make money compared to the little guy, because the little guy just doesn't have enough. Now they're trying to get there. But if I'm putting my money in a bank, am I going to put it at the little guy who's trying to catch up? As much as I like to say I'm an idealist and I like to root for the little guy, I'm not risking my money on the little guy.
Well, and right now, especially because this is a self-fulfilling prophecy, if you get enough people talking about it, it's going to create its own headwind. And I think that's kind of what we're seeing right now. This has become a top of mind topic of conversation for everybody. And I think a lot of folks right now are second guessing the institutions where they have their money at. Right, wrong, or indifferent, they're doing it. And it's because of all the talk. And it's a forest fire, where the bigger the fire gets, the more oxygen it pulls in, and it creates its own weather system that feeds its own growth. And we could be in that cycle right now. So you're thinking right now, based on vacancy ratios, commercial, actions from the feds,
run on deposits,
and regulation, and the cost of regulation being more prohibitive for smaller banks, for these reasons, that we might just be seeing the tip of the iceberg. So 100%. It's a scary proposition. And for all of you who say, well, that absolutely cannot happen. Well, you know what? You might be right. It might not happen. But if you're going to read the tea leaves of the market and look back at history as the best indicators for what's going to happen in the future, you've got a pretty good provenance right now from back in 2007, 8, and 9 that this is in fact going to be the case. It's not that the feds can't come in and intercede, so to fund some of these banks, to prop them up if they chose to. But if you start seeing them going down left and right and it becomes a game of whack-a-mole, it's just going to be easier to delegate this to the 5 or 6 top banks in the country and allow them to do it rather than on a federal level.